In the past, we've seen value investing outperform after a major correction as the market starts to recover. Now, we've already seen a significant correction. The Nifty 500 index fell by 23% between September 2024 and March this year. Now, markets seem to be in a recovery phase right now. But a lot of experts believe that the recovery could be slowed due to the start of a global trade war thanks to Trump's tariffs. Now, if all this plays out by the book, we could see some value and contra funds outperform this year. So we thought, why not compare three of the biggest value and contra funds? Hello and welcome to ET Money's YouTube channel. In this video, we will compare SBI Contra, which was the first contra fund in the country, with ICICI Prudential Value Discovery Fund and Invesco India Contra Fund. But before we begin, please note that the funds we discuss in this video are not our recommendations. We will simply compare the three funds on various parameters such as returns, consistency, and performance during tough times, among others. Now, this video is going to be highly insightful. By the end, you will be able to decide which fund is best for your portfolio. So do watch till the end. Now, let's begin with the basic information about the three funds. Now, according to regulations, a fund house can offer either a contra fund or a value fund. No fund house can have schemes in both categories. Now, that's because value and contrarian investing styles are the two sides of the same coin. Most value investors are contrarians. Take the example of Shankar Narayan, who is the Chief Investment Officer at ICICI Prudential Mutual Fund. Over the past 2 years, he has been saying that banking stocks are undervalued. This was a contrarian call as most investors stayed away from banking stocks due to the challenges the sector was facing. Now that you know there is no real difference between value and contra funds, let's briefly talk about the three funds to know them a little better. ICICI Prudential Value Discovery Fund is the largest among the three funds we are comparing. Launched in August 2004, it has over 49,000 crore in assets under management. SBI Contra Fund was launched in July 1999 and holds assets worth 42,000 crores. Finally, Invesco India Contra Fund is the smallest among the three. It has 17,000 crores assets and was launched in April 2007. Now, all three funds follow either Nifty 500 or BSE 500 as their benchmarks. Okay, let's now look at the returns of these funds. We have compared the funds on their 3, 5 and 10-year returns. Now, over the last 10 years, there has not been huge difference in performance. Invesco India Contra is at the top with 15.64% returns. ICICI Prudential Value Discovery is third with 14.39%. All these returns are close to the category average of 14.18%. However, the picture changes when you look at short and medium term returns. In the past 3 and 5 years, with a 35% return, SBI Contra Fund has outperformed the other two funds by a wide margin. However, all three funds were comfortably ahead of the benchmark and the category average. Now, we also checked recent returns from the start of this calendar year. All three schemes had negative returns. However, there's a twist in the tale. ICICI Value Discovery, which underperformed the other two funds in 3, 5 and 10-year periods, did exceptionally well in the year-to-date comparison. ICICI Value Discovery Fund fell just 10%. On the other hand, the returns of SBI Contra and Invesco Contra were -22 and -32% respectively. Invesco did worse than the category average and the benchmark, which were -28% and -23% respectively. Now we can see that how well the ICICI Value Discovery Fund has contained the fall among the three funds. So can we say that this fund works best among the three in a tough market? Well, not yet. We will come to that a bit later. First, let's also check the rolling returns to see how consistently these funds have performed. Trailing returns just compare performance in one period, that is from one day to another. Rolling returns, on the other hand, examine hundreds or thousands of data points. We then average these returns. This way we can see how often the investment yielded good or bad returns and understand its performance consistency. Now, we have 5 and 7-year rolling return data for all three funds, along with the performance of the category and the Nifty 500 TRI index. Now, let's zoom into these returns. Among the value and contra funds, Invesco Contra stood out as the clear winner, followed by ICICI Value Discovery and SBI Contra for both 5 and 7-year rolling returns. Invesco India Contra has delivered an average 5-year rolling returns of 17.92%. ICICI Prudential Value Discovery followed with 16.3% and SBI Contra with 16%. All three funds have done better than the category and the Nifty 500 TRI. Now moving to the 7-year rolling returns, and the result is the same here. All three funds have outshined both the category average returns and the benchmark. You can see how the topper has changed while looking at the trailing returns and rolling returns, where we saw that the SBI Contra performed best in trailing returns. However, in rolling returns, it was behind the other two schemes. So what went wrong with SBI Contra? Why is it lagging when we look at the rolling returns? Now, it's clear that SBI Contra has not been a consistent player in the long term. It's possible that its performance improved and it turned around in the last few years. So we dug deeper. One possible reason for the turnaround could be the change in the fund manager. In May 2018, Dinesh Balachandran took over the fund, and since then its fortune has changed. The fund manager made deep changes to the fund's portfolio, which was evident in its portfolio turnover ratio. Since the new fund manager took over, this ratio has increased multifold. It went from being 44 in 2018 to 124 in 2019 and to 230 in August 2023, the highest among all value and contra funds at that time. Now, for those who are unaware, a portfolio turnover ratio tells us how often the fund manager buys and sells stocks. A ratio of 100 means the complete portfolio was changed over the past year. So, a portfolio turnover ratio of 230 in the case of SBI Contra fund means that the fund's entire portfolio was changed twice. That's fascinating, isn't it? Later in this video, we will compare the portfolio turnover ratio of all funds. Let's first look at the volatility or how risky these funds are. For this, we look deeper into rolling returns. Here, we check the fund's minimum and maximum returns as well as their standard deviation. This is the measurement of the volatility of a fund. The higher the standard deviation, the more volatile the fund is, and vice versa. Let's begin with the 5-year rolling returns. We will compare the three funds under consideration first. The gap between minimum and maximum returns for SBI Contra fund is the widest. Its minimum return stand at -4% and the maximum is 40%. This shows that the fund is the most volatile among the three. Now, as you can see, the gap is wider than the category average and the benchmark Nifty 500 TRI as well. Next in line is ICICI Prudential Value Discovery Fund with a minimum and maximum range of -2 and 36%. So, while the minimum returns for SBI Contra and ICICI Value Discovery were negative, Invesco managed a positive minimum return of 2% and the maximum return stood at 31%. The gap is not as wide as among the other two funds. Now, instead of examining the gap between the minimum and maximum returns, if we look at the standard deviation, we get the same picture. Going by the data, SBI Contra is the most volatile with a standard deviation of 8.5, followed by ICICI Value Discovery and Invesco Contra funds. Now, when we compare the standard deviation of these funds to the category average, only Invesco India Contra did better. It means that this fund is slightly less volatile than the other funds in the category on average. Now, when we look at the 7-year rolling returns data, the picture is no different. SBI Contra is the most volatile. Till now, we've seen the performance consistency of the three funds. But what about their performance in falling markets? Were these funds able to limit the downside when markets stumbled? Let's look into details in the next section. To see how the funds performed in tough markets, we looked at the quarterly returns of the Nifty 500 TRI index for the last 15 years. We filtered the quarters where the market were in the red. Next, we looked at how the three funds under consideration performed during those quarters. Let's look at what we found. Out of 60 quarters, the Nifty 500 index was negative in 21 quarters. Of these 21 quarters, ICICI Prudential Value Discovery Fund was positive in 5 quarters, followed by Invesco India Contra Fund, which was positive in 2 quarters, and SBI Contra in 1 quarter. In fact, in 15 out of 21 quarters, ICICI Value Discovery Fund has fallen less than the broader markets. Invesco has fallen less in 11 quarters, and SBI Contra, the number is the lowest at 9. So ICICI Prudential Value Discovery Fund is the best performer among the three funds in turbulent times. SBI Contra was the least successful in containing the losses when the markets fell. By now, you should have a fair idea of the risk and return profiles of the three funds. Next, let's try to decode their investment styles by looking at their investment and portfolio allocation. To understand how the funds invest and manage money, we started by examining their asset allocation among large, mid and small cap stocks over the last 5 years. This will help us understand the change in allocation patterns of this fund. Now look at the chart on your screen. ICICI Value Discovery heavily invests in large cap stocks with an average exposure of around 72% at all times in the last 5 years. So this fund's high and consistent allocation to large caps could be a reason for the fund's better performance during bad markets. Invesco India Contra fund has also maintained a consistent allocation to large caps of about 67%, but since last August, it has dropped to an average of 56%. Now, look at the mid-cap allocation chart. SBI Contra shows wild rides. Its mid-cap exposure in the past 5 years have ranged from 7% and 30%. Since January last year, the fund's mid-cap allocation has fallen from 30% to 13%. ICICI Value Discovery Fund has maintained a low allocation of 6 to 7% to mid-caps since September 2021. Invesco, on the contrary, has been raising its mid-cap allocation over the last 2.5 years. The exposure went from around 10 to 23%. Moving to the small cap allocations, we can see SBI Contra has seen wild swings here as well. The fund manager has reduced allocation from a high of 38% in mid-2021 to 11% in March 2025. Invesco has been increasing its allocation to small caps over the last 2 years, whereas Value Discovery Fund has maintained its small cap allocation to a low level of around 5% over the previous 1.5 years. So this is what the asset allocation of three funds tells us. SBI Contra is the most aggressive of the three as it has maintained the lowest levels of allocation to large caps. It has also actively moved its allocation to mid caps and small caps in the last 5 years. This hyper-reactive management strategy could be the reason for the fund's turnaround in the previous few years. ICICI Value Discovery, on the other hand, is a conservative fund with a high and consistent allocation to large caps. Invesco India Contra comes somewhere in between. It has maintained a high allocation to large caps but has been actively managing its mid and small cap exposure. The active management of portfolio allocations is also evident from the portfolio turnover ratio. The portfolio turnover ratios are on your screen. As you can see, ICICI Value Discovery and Invesco India Contra have maintained an average portfolio turnover ratio of around 55 to 65%. In contrast, the SBI Contra fund has had a high turnover of more than 100% since 2020. In March 2025, it had a turnover ratio of over 200%. It means that the fund is very active in managing the portfolio. Based on the data, it appears that the fund is not a fan of a buy and hold strategy. Now, a high portfolio turnover ratio for such long periods may also raise questions about a fund manager's conviction in his investments. So, let's now take a quick look at the stocks in the portfolios of these three funds. Now, all three funds are well diversified. ICICI Value Discovery holds 65 stocks in its portfolio. Invesco Contra has 70 stocks and SBI Contra holds 80. Now, we also check the common stocks in the portfolios of the three funds. The data is on your screen. The top holding in all three schemes is HDFC Bank with an allocation of 8%. These funds have 8 stocks in common. Besides HDFC Bank, the other stocks include ICICI Bank, Axis Bank, Infosys, L&T, ITC, Lupin and Gland Pharma. Now, an interesting thing to note here is the allocation by the three funds to these 8 stocks. The allocation percentage to these 8 stocks is similar for ICICI Value Discovery and Invesco Contra. However, SBI Contra allocates way less to most of these stocks. For instance, it has less than 2% allocation to ICICI Bank, Axis Bank, Infosys and L&T. Okay, let's also talk about how these funds differ from other categories and whether they truly invest in value or contrarian ideas. Well, the top holdings are no different from usual big names. Also, it's very difficult to judge if a fund is truly following value or contrarian investing overall, as there is no standard deviation of value or contrarian investing. All three funds have significant assets under management. The larger the fund size, the more difficult it is to consistently fund contrarian or undervalued stocks. As an investor, it's best to leave it to the discretion of the fund managers as long as the fund has a proven long-term track record. Now, let's sum up the overall performance of these funds. In the case of rolling returns, Invesco India Contra wins over the other two. Asset allocation shows that SBI Contra is the most aggressive of the three funds. It has maintained the lowest levels of allocation to large caps and tweaked its mid and small cap exposure a lot in the last 5 years. ICICI Value Discovery, on the other hand, is a conservative fund with a high consistent allocation to large caps and better downside protection. Also, keep in mind the change in fund manager of SBI Contra, which has seen a major turnaround in its returns in the last few years. So, if you plan to shortlist any of these schemes for your investment, keep these points in mind. This was about the biggest value and contra funds. Which fund would you select for your portfolio? Would you like to go with a consistent performer or the one that helped limiting the losses in bear markets, or would you like to be a part of a mutual fund's turnaround story? Do let us know in the comment section. And if you found this video useful, do share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.